Welcome to a little preview of our Future of Private Investing event, which is coming up this June. I'm Dan Jones, the Deputy Editor of Investors Chronicle, and with me is Alpesh Patel, the CEO of asset manager Praefinium. Alpesh is going to be speaking at our Tactics for Difficult Markets session, and on that subject, these are certainly difficult markets, Alpesh, I wanted to ask you, can the US avoid a hard landing? That's the big question at the moment for a lot of people. What do you think?
Well, the thing is, it can, but there's no way of knowing for certain whether it will. Of course, they're trying to, but think about it. Last year, inflation in the US was at 6.5%. The Fed's target rate is 2%. And they've got one instrument, really, which is interest rates. Okay, you could do some quantitative tightening through bond purchases. There's a big room for missing that and overshooting and it being a hard landing. And I think what private investors have got to prepare for is the worst case scenario, not the best case, because the best case, you're sitting on a beach and you're happy. It's the worst case scenario. And if there's a hard landing, what's in their portfolio which would protect them from it? But if there isn't, they'd still benefit from a rising market.
What about China? A big question at the moment as well, the Chinese reopening post-lockdown. How could that affect markets this year?
Well, consider that their growth was 8.1% in 2021, so before COVID really hit, was 8.1%. This year, 2023, it's projected to be 5.5% GDP growth. That is a new United Kingdom and France, just created by China alone. That's huge, and that should trickle to the rest of the world, of course. The problem is to what extent and how quickly and how much is it already factored in? And do you rely on Chinese equities, which have been battered down by policy and a multitude of other factors and the lockdown? Or do you say to yourself, well, actually, it should benefit their trading partners, such as the United States, and I'd rather have the relatively safer markets, the developed markets, rather than be exposed directly to Chinese stocks. And the halfway house that I think is far more interesting are the Chinese ADRs, the Chinese stocks listed on the New York Stock Exchange, because at least you've got Western regulation going through their figures and their accounts, and yet you've still got exposure to China.
I've got a poser for you. This year, in general, should investors be positioned for recession or for recovery?
Both. And the reason I'm saying that is not just because a year from now somebody's going to play this back and say I was right or wrong. This way I'll be both. But actually, it's got to be both every time. Did you foresee the financial crisis? I didn't. Did you foresee COVID? I didn't. Okay. Yet, was my portfolio fine? Yes, because it was positioned towards somebody out there in financial services messing it up. Now, COVID, I can't blame on my fellow asset managers and the city, but the financial crisis I can, and probably the next crisis, I will blame on those people, those experts trying to get it right. So I've got to always allow for the fact that if the market falls, that I've got the kinds of stocks which should be resilient and shouldn't fall as much because they're cash flow generative, they're growing well, and they're relatively undervalued. I'm not gambling on is it a value stock, a growth stock, a cash flow stock, or a dividend stock. It's got to tick every single one of those boxes. And equally, if we get a tailwind, then those are exactly the kinds of stocks which should do well anyway. So that's the only way to position. I certainly don't want to be gambling and relying on the Fed or any other macroeconomic or political actor pulling the right levers at the right time. I need my destiny in my own hands, and that means I've got to make sure those stocks tick every single box.
Alpesh, thank you very much. We're looking forward to a great discussion on the 15th of June in London.
Thank you.